Good afternoon, friends. On this nice Saturday of early March, we are here today to have a discussion on markets, and we want to have the discussion with Professor T S Ramachandran. So, TSR sir, as we know him for so many years, for decades, I should say, right, was a professor of finance at Christ University MBA school, right, and that was till recently. And before that, he was in the markets as a head of treasury in Vaisya Bank and in ING Vaisya Bank, and later he was also with ING Vaisya Mutual Fund. So he has a rich experience right beginning from the 80s, and the kind of events and the way the markets have developed in the 90s during the period that he was in markets, right? And also I had the privilege to be associated with him in the Vaisya Bank Treasury. So we wanted to discuss some of these events and hope this will be useful to the practitioners as well as the students of finance, students of markets in today's day and age. Yes, sir.
Thanks, Raman, for inviting me for this podcast. It is my pleasure to share the experience and the knowledge with the audience. And I should mention here that you were the go-to man for me in the treasury. And it was always a team which we worked with. And it was very good experience. And so let us go ahead and share our experience, because this period is packed with lot of
events and very seminal events, milestones.
True.
In India's financial market history. And I leave it to you, sir.
We are talking about the 90s, the complete 90s,
yes.
And a part of 2000, early 2000.
Yes.
So that's a period when the markets, Indian markets, we are talking, the focus is on the Indian markets, and the reforms which took place, the events which took place.
Yes.
And so the entire market evolved during this period, we can say.
Correct. So I think, would you say that, since we are talking about the 90s, the beginning of the decade, 1991, was a seminal year in so many ways.
Yes.
So that was when the new government took charge, right? Unfortunately, we had this Rajiv Gandhi assassination. So to the surprise of everybody, P.V. Narasimha Rao, who was supposed to retire and go home to Hyderabad, he suddenly became Prime Minister, right? So 91 onwards, sir?
Yes.
So, and 91, this was also the time that Dr. Manmohan Singh became the Finance Minister of India, and that was the point of the great liberalization of the Indian economy. Now, liberalization is one thing, and subsequent to that liberalization, what are the events that transpired, that followed 1991? Sir, would it be fair to say 1992 was the landmark year after 1991?
Very true. 1992, the Harshad Mehta scam which took place shook the market and shook the banking industry in specifically.
Absolutely.
And so that triggered a lot of reforms in the markets and the banks together. Because the modus operandi of Harshad Mehta scam was the issue of bankers' receipts.
Yes.
The technology at that time was not that much prevalent.
Correct.
And because of that, certain practices which were followed, though not the best of the practices, led to embezzlement of banking money by certain individuals.
Right.
So the modus operandi in the case of Harshad Mehta scam was issue of bankers' receipts, which typically a bank which is borrowing money against the collateral of the government securities issues to the lender bank. It's sort of an undertaking or a commitment or a proof saying that we are holding government
such government security as an underlying.
As a collateral on your behalf. We continue to hold it. Though the government securities are with the Reserve Bank of India. We hereby say that we are having it in our custody.
It is a kind of a declaration or self-declaration.
And so that was the basis on which the money was lent and borrowed by banks
in the interbank
through the repo transaction in the interbank market.
Yes.
Now, some unscrupulous elements understood that this can be exploited. And then they went to small banks like Bank of Karad or Bombay Mercantile Cooperative Bank. And so they associated themselves with the treasury. They entrenched into the treasury of those banks. And then they gave the bad idea of issuing bankers' receipts, even though you are not
Without the underlying.
Without holding securities.
Right.
And then you are basically borrowing money,
Yes.
saying that we are holding the securities, and on the basis of those securities we are borrowing money. But whereas you
don't have those
you
securities.
don't have those securities,
Yes.
and those money were raised by these banks, and
Yes.
then this money were given to
the broker.
Given to the broker like Harshad Mehta. Mainly Harshad Mehta.
Harshad Mehta as a lending from the banks.
As a lending from the banks.
Yes.
The banks borrowed from another bank
Yes.
against bankers' receipts,
Right.
which are not authentic, which are not very authentic.
Yes.
And then the money was used by
the brokers.
By the broker to
Yes. To pump up the stock market.
into the stock market.
Yes.
So we had the very infamous this thing of the markets going up, particularly scripts like ACC, which moved up from 200 rupees to 9,000 rupees.
10,000 rupees.
10,000
Yes.
rupees.
Yes, yes.
And then the whole of the markets was pumping up.
Was on fire. Markets were on fire.
On this liquidity.
Yeah, and actually at that time we didn't realize what was happening. Right, when the markets were going up, I remember, because my career in market started in 91. So
Okay.
91 December, Sensex was 1,900. At the peak of Harshad Mehta, before the scam was found out, in April, I think it was 4,500. So 1,900 to 4,500 in a matter of 3-4 months. Right, so that was huge. So one point maybe I would like to emphasize, maybe the audience is aware or not aware, I don't know. People generally talk about this period as a stock scam. Right, so actually it is not a stock scam. I would say it is a bank scam.
Bank scam.
No, because stock market, nothing wrong happened in that sense. There was no scam within the stock market. And this is something that the late Mr. M.R. Maya, sir, Mr. M.R. Maya was the chief of the BSE, Bombay
Yes.
Stock Exchange at that
Yes,
time.
yes.
So he used to say, so all the settlements went through normally, all transactions in BSE went through normally. It was not a stock market scam. So why I just wanted to mention this is because the reforms that started because of this incident, right, we fixed all the weaknesses which were
Within
there.
the banking system.
The weaknesses were in the banking system.
System with reference to the government securities market.
Exactly. With reference to the government securities.
Because a banker's receipt is basically
an instrument used by the banks.
by the banks.
And it was wrongfully utilized.
True.
So that is TSR sir. So in that particular reform to fix this issue, can you tell us what happened actually? What did RBI do?
So 1992 was a time when Dr. Rangarajan was the governor of Reserve Bank of India. He
Yes.
took over from Mr.
Venkataramanan.
Venkataramanan.
Yes.
And so Dr. Rangarajan came into the Reserve Bank of India, and soon after that this happened, unfortunately. So he took a lot of measures
Yes.
which strengthened the whole of the banking treasury in general.
Right.
So to start with, the bankers' receipts were banned,
abolished.
Were abolished.
Yes.
And the main thing is the banks were asked to draft investment policy.
Okay.
Before that, there was no investment policy, formal investment policy approved by the board of directors of the bank.
That was amazing, because when I came to Treasury in 97 or 98, you asked me to review and prepare for the board for the next year's this one. I thought it was a routine thing. It is amazing. It started only in 92,
Yes.
after 92.
Yes.
Wow. Okay.
And then one of the major reforms happened was in the case of the settlement of the
Government securities.
Yeah. It's called the Delivery versus Payment System, DVP1, then DVP2 and DVP3.
Okay.
So in DVP1,
Yes.
every transaction gets settled on a transaction to transaction basis.
On a gross basis.
On a
so
gross
for
basis.
each deal that we do in
Yes.
government securities, so if it is a purchase, that security has to be delivered and the cash given.
Has to be, yes.
Funds have
On
to
a
be
transaction
given.
by
transaction to transaction. So,
Yes.
Okay. That was DVP1.
DVP1.
Okay. Okay.
On DVP2,
Yes.
the cash was settled on a net basis, but the securities were settled on a gross basis. On a gross basis. That's how that was happening.
Okay.
DVP3, both the funds as well as the securities
Yes.
were happening on a net basis.
On a
Suppose
net
if we are doing a transaction on a particular day,
Yes.
if we have sold some securities and bought some securities,
Yes.
the net, I may have to pay you or you may have to pay me, and the
Yes.
net, that is called the net settlement.
Net settlement.
And
DVP.
similarly, if the securities are same,
Yes.
then that also happens on a net basis.
Net basis.
So that is the DVP3.
Yeah.
So
So that was critical, right?
That was very
this entire
critical.
SGL, because if I remember correctly, at that time, this entire CSGL, Central Government Securities Ledger.
Yes.
SGL was being maintained by a clerk in SBI in Fort Branch.
Fort Branch, yes.
Right. So he was trying to handle all these transactions. He was completely overwhelmed, and that led to other malpractices which was exploited by brokers.
That's true. That's true.
Yeah. So that entire thing, I think it got computerized.
Yes.
Entire SGL, the general ledger of, it was taken over by RBI, and they put a lot of technology and processes into it, and they made it foolproof.
Yes.
Yes.
And as a fallout of this scam,
Yes.
the first thing which RBI did was a reconciliation. They called all the banks to the Reserve Bank of India and said that how many people have issued, how many banks have issued bankers receipt,
Yes.
and in favor of whom, and who has issued. So they had to bring everything together, and then they could assess the extent of fake BRs which were issued and BRs which are issued without underlying, and things like that. And as a fallout of that, Bank of Karat got closed, and Bombay Mercantile Cooperative Bank also got closed. So that was the thing.
And I think many other banks were in trouble, right?
Many other banks were in trouble.
Yes.
And so the investment policy came in place, and within the investment policy, strict adherence to the limits, the products which they will handle, and the bifurcation, the powers, the limits, the bifurcation of the front office and the back office. All those things were brought into that, and also the portfolios were classified into current and permanent,
which was
not there before.
Okay.
And so all this happened.
All these reforms have taken place
as a fallout of this
of the Harshad Mehta scam.
Of the scam.
So I think one more thing which probably came was this concept of broker empanelment.
Broker empanelment,
right?
Very true.
Because that enormous volumes being routed through one broker gave that broker undue influence on the transactions being done by the bank treasury. So they came out a broker policy, a circular by the RBI, which said that not more than 5% of the total volume of the government securities can be with one broker. So I suppose that was another fallout.
Yes. And prior to that, everyone understands who are in this market that the government securities market lacks depth. In spite of the fact that the government of India borrows
such enormous
money
sums of
and
money.
issues bonds.
Yes.
The outstanding securities are huge, which the banks hold it in the form of statutory liquidity ratio.
Yes.
But the depth was lacking. So there are no prices for many of the securities, many of the bonds which the government has issued. So when it comes to the balance sheet date, and when we have
you do the valuation,
when we have to do the valuation part of it, where are the prices? Where are the market prices? So mostly it was not available.
Right.
And there is such a practice which is not good that we used to go to brokers and ask, can you give us the price of this particular security? And that particular security would not have traded in the market, and the broker tells back saying, sir, what price can I give you? Because it's based on the broker's prices that
you will do the valuation and pass the MTM.
And the mark to market. And so see from where, and we have moved to where. It's all a part of that scam which came to light. All this, which all this practices.
And that changed so many things, reformed so many practices, which helped the evolution of the Indian financial market into the next level.
Yes.
So I think 1992 that way had a very large impact. So after that, what is the major landmark that comes to mind, sir?
And then the market reforms started. The market reforms parallelly started. 1992, once these reforms were introduced by RBI, and they were very strict on the investment policy and the contents of the same and the mark to market and stuff like that. The other reforms were happening, and 1994, the current account convertibility happened.
Okay. That's a big deal.
That's a big deal.
Very
because
big deal.
1991,
we were on the verge of default. We had just $1 billion in our FX reserves. And from there, moving to trade account convertibility or current account convertibility in 94.
Yes.
That's a very big step.
Yes.
So that was in 93, 94.
Yes.
And that was, that kind of, did it stabilize the currency market, or did it bring a little bit more volatility or more active?
See, prior to the current account convertibility in 1994, in 1993, the Reserve Bank of India had already opened up the foreign exchange markets for the rates, FX rates, to be market determined.
Okay.
Because prior to that, the Reserve Bank of India was giving out its rates on the four major currencies like US dollar, British pound, Japanese yen, and one more currency,
Australian
euro.
dollar.
Euro was not
Euro
there in 19...
Australian dollar maybe.
Australian dollar
franc.
maybe. So these currencies, the Reserve Bank of India used to give the daily rates.
Right.
And that is the rate at which the market was
would trade only around that.
Yeah. So 1994, after the current account, 1993 this happened.
Right.
The market determined rates. 1994, the current account convertibility happened.
Right.
So 1995, so the market reforms have started slowly one by one.
Right.
And 1999, the Foreign Exchange Regulation Act, FERA, was replaced by
FEMA.
By FEMA.
Foreign Exchange Management. So regulation we came to management.
True.
But it was not just semantics, right? It was actual genuine reform there.
Yeah, correct. Right. As against the FERA, where they limited the use of the foreign exchange.
Yes.
They went into how the foreign exchange can be managed in foreign exchange.
Rather than controlling or regulating it, the little bit of risk management from the Indian economy point of view.
Yes.
Those kind of regulations came in.
And any violation of FERA was considered as a criminal offense.
Yes.
But whereas in FEMA, they consider it as a civil offense. Civil offense.
Yes.
And so, as against a restriction in FERA, it was more of management and this.
No, that
so it
reminds
was forward-looking.
Yes. So those kind of reforms are still not over. We are still doing that. I think recently, the finance minister was saying, or was it the prime minister, that I think around 200 different instances under law which are considered a criminal offense will become a civil offense. So they want to improve ease of doing business. So it looks like we are still on that path of reform.
Very true.
So that was 99, sir. But before that, after 94 and after that, 95, was there something? I'm just trying to see if every year is there something that was happening.
No, not necessarily. But 97, the Asian financial
crisis started.
Yes.
Yeah, late 97 it started. And I think that 97, 98 was a very tough year. I think there was a collapse of this hedge fund called LTCM. Long-term capital management. It turned out it was not really long-term. It was trying to capture arbitrage out of short-term difference in market. That was LTCM. Then Russia defaulted on its debt. So that was 98. And 97, 98, these are the events which happened. And it was triggered off by, I think, the Thai baht collapse.
Yes.
Thai baht collapse, the Korean won collapse. So it was a time of great turbulence and great uncertainty. And this is the time, sir, we were looking at call money rates at 100%.
At 100%, yes.
In 98.
Yes.
So 100%, and we are still happy because in Hong Kong it was 300%. So we are only at 100%.
Very true.
Yeah.
So the Asian financial crisis happened because of the lot of money, foreign exchange dollars coming into US dollars, getting into Thailand and to prop up the real estate business there.
Real estate market.
And real estate market, and the asset bubbles got created.
Correct.
And once they wanted to exit by selling those real estate business, that is when they found that the country did not have enough dollars,
enough reserves
for the exit of the currency. So with the result, Thai baht crashed.
And then there's Indonesian rupiah, Korean won. I think if I remember correctly, at that time the currencies were held too stable for too long a period.
Absolutely.
And then
not really reflecting the value of the currency.
Yes. So and then suddenly when there was a huge demand, there was a blowout. And I think IMF signed this, document with Indonesia, and then of course they came to the bailout. So from Indian markets point of view, it was a very tense period. 98 was a difficult period.
97, we were talking about capital account convertibility because the current account convertibility has fallen in place
just in 93, 94. And 97, we were talking about capital account convertibility.
The Tarapur Committee
report
constituted to look into the capital account convertibility aspects, how the country can move into capital account convertibility. In the meanwhile, this Thai baht
the Southeast Asian crisis.
And everyone appreciated that the country did not move into capital account convertibility.
So we were fortunate, that we did not take that step. Maybe it was far too early. Because, you had a crisis in 91 and you became trade account convertible in 94. 97 becoming capital account convertible is far too soon.
How much of resources you would have had?
Yes. And now we are at 2025. and we are still not ready in 2025 to become capital account convertible because the structure of the economy does not support that kind of a thing.
Yes.
So, sir, in 97 and 98, of course, there was this one, and 99 we had the Kargil War.
99 we had the Kargil War.
Kargil
Yes.
War. Yeah, so that was another event which jolted markets.
Yes.
There was also in between a ratings downgrade on India's sovereign rating in 99, sometime around July. So, so 99 also was a difficult year in that sense.
If you look at the market reforms,
Yes.
in 1999, the rupee derivatives were allowed by the Reserve Bank of India.
Right.
And gradually the Reserve Bank of India was looking at the markets, the financial markets, particularly for the wholesale market, for
Yes.
the banks and other institutions functioning in this thing.
Yeah.
For them, they were looking forward and opening up these areas where
Yes.
banks can manage the balance sheet better, manage the
risk better.
risk better.
So to liberalize and open up different products. So instead of RBI sitting there and trying to control everything.
Control everything.
So they will create a market environment and give the tools to the banks to do that risk management themselves.
True.
Right. So I think by rupee derivative, you are referring to the OIS?
The interest rate swaps.
Interest rate swaps. Yes.
OIS is a part of that interest rate
OIS
swap.
interest rate swaps.
FRS.
FRA.
No, they were talking about the yield curve to evolve.
Yes.
No, with the
Yes.
forward rate agreements.
Correct.
No, they
Correct.
believe that the yield curve will evolve.
Yes.
And the government securities will be better priced.
Yes.
And it will have better depth.
Yes.
And before that, one interesting thing is that, as you rightly mentioned, when the liquidity crisis happened
Yes.
in 95, 96,
Yes.
the call money rates touched 100%.
Yes.
And
So in 98, sir.
96, 96, I remember it.
That was when I think in February 96, rupee came under severe pressure.
True, it could have been a result
correct,
of that,
correct.
the liquidity
Correct.
drained and
Yes,
that.
yes, correct.
And the banks did not have a fallback mechanism to
manage the
RBI,
liquidity
to manage
stress.
the liquidity.
Yes.
And the refinance facilities were not available. The liquidity adjustment facility, LAF, were not available.
Right.
It was not in place.
It was not
So
in
I think subsequent to that,
Yes.
RBI created these refinance mechanisms where the bank's treasury can manage the liquidity in a better way.
Right. So that's when we had this interest rate corridor of a repo and a reverse repo.
And a reverse repo.
And reverse repo, you can park your surplus funds with RBI, and repo is when you can borrow from RBI. And later there was this MSF, marginal standing facility, where with a slightly higher rate you can borrow from RBI. So this corridor, I think that gave a lot of stability to the liquidity management, and that kind of anchored Indian rupee interest rates. And that kind of also led to the smoothening or kind of more confidence in the GSEC market. And this was a period when we saw a steady decline in government security yields.
Yes, around that time, 95, 96, we should also recall that the statutory liquidity ratio and the cash reserve ratio were at very high levels.
Yes.
The SLR was at 38.5% and the CRR was around 15%. 15%. So totally around 53% of the money was managed by the treasury.
Right.
And the balance only around 47%, 48% was
the rest of the bank in terms
for lending. For lending.
Yes.
So,
and in that 40% is private sector.
Yes, true.
Yeah.
And so that was that is a very high, and the interest rates are also high.
Yes.
We should recall that the government of India borrowed money for a 10-year period in 1995 at the rate of 14%.
Absolutely, sir. So that was the first 10-year benchmark in the government securities market in India's history. Right, till that time we had something called undated treasury bills.
True.
Right, undated treasury bills which used to
treasury bills, yes.
Yeah, ad hoc treasury bills, undated treasury bills which used to be funding the fiscal deficit of the government of India. And after, following this 1992, there are a number of reforms that took place. This was one of them. Creation of a proper benchmark security, creation of an auction system for Government of India securities, where the first one, as TSR sir said, was 14%, 2005, was the 10-year benchmark security issued in 1995. And from there, that was probably the peak of GSEC yields.
And one of the important things which we need to recall is, Raman, when Dr. Rangarajan took over as the governor of the Reserve Bank of India. Yes. The system which was prevailing for the government borrowing was that whenever government required money for expenditure,
yes,
they come to RBI and ask money, and there was something called WMA. Ways and means advances. And through that, it's like an account.
It's like a cash credit account.
It's an open account, yeah. Yes, and whenever the government wants,
they will just take the money. Yes.
And so there was no market-related mechanism for the government to come and borrow at market rates by paying interest. So this was completely revamped by Dr. Rangarajan, and during his time, the WMA balances were converted into treasury bills. Right. And then the dated treasury bills came, 15-day treasury bills, 90-day treasury bills, 364 days treasury bills were issued. And the government of India started borrowing from the market instead of going to the Reserve Bank of India and taking money in the form of ways and means advances.
Yes. So that was I suppose if you look at it now, it looks very primitive or very backward.
But those are the baby steps.
Those are the baby steps, because, now it is like fiscal deficit financing, the deficit financing cannot be done by the central bank, right? So, but that's how it was happening.
Yeah, it's only through market borrowings that you can manage your fiscal deficit.
So that, earlier there was no interest rate signal to the government to say that you are borrowing too much.
Yes.
Right. So now the market will give you the signal, right? And we have heard of something called bond vigilantes, thankfully not here in India, but US we have heard of that. So the bond market will act as a disciplining agent for excessive fiscal deficit. So that is a different subject. Sir, 95 you were also talking about, bearings, something happened in bearings.
Yes, 95, the Barings collapse came.
The Barings Investment Bank collapsed.
Yes, the Singapore, it's a London-based bank, but then they had operating in Singapore.
Yeah.
And again, the rogue trader,
Nick Leeson, the famous rogue trader,
took positions in the Cymex.
Yes.
And then he was a star performer earlier.
Yes.
So he was generating a lot of profits.
Yes.
And the superiors were happy, his superiors were very happy because they were getting a lot of bonuses of the profits which he was making. So no questions were asked.
Yeah.
Once he started making losses, that is the time when he started trying to put these losses in some account and then try to
cover up those losses.
Cover up the whole thing. Yes. So basically he issued, he went short on straddle.
Yes.
And that strategy works if the market is stable.
It's within a range bound.
Within a range bound. Because he sells call option as well as put option at the same strike price on the same underlying at the same maturity period.
Yes.
And so he collects the premium.
Yes.
And if the market is stable, both the call and the put option will not be exercised.
Right.
And the premiums will be his income.
Yes.
That's how he was operating.
That's how he was operating.
But when the earthquake in Japan, the Kobe earthquake happened, the market fell, the Cymex fell.
Right.
And then that triggered the options and he went into huge losses.
Correct.
And that is the time he could not manage the earlier losses, which he was trying to cover up. And so the exchange was asking for the Cymex, the Singapore stock exchange, asked for margins. And that is the time when he had to ask, he had to come out and tell that these are the losses.
Yes.
And all hell broke loose. And the whole bank, which is about...
It was a storied investment bank with a great history, great heritage in UK.
Yes.
And it just collapsed.
Well, the royal family had their accounts. Had the accounts. And that had to be sold to ING for £1.
Yeah. So, in a way, we have some kind of connection because we worked in Vysya Bank, became ING Vysya Bank, and ING paid £1 to take over bearings, and it became ING bearings.
Yes.
So after that, I don't know what happened. That's a different story. So 95 was another. So it's a kind of another milestone event.
Yes, and the fallout of that is whether the bank treasuries are the reporting system particularly is in place or not. I remember in our bank treasury, the Reserve Bank of India came down heavily on saying that the front office operations and the back office operations are getting reported at a very low level at the vice president level or at the assistant general manager level, which is not acceptable to them.
Right.
And they said that it has to be almost parallel and the convergence can happen only at the CEO level. So not below that.
Right.
So the back office was reporting ideally to the audit head.
Okay.
But whereas the front office was reporting to the CFO.
CEO.
CFO, and the CFO and the audit head will report to the
Right. Right. But at that time, the CFO, I mean, I'm still thinking of the 90s.
Yes.
CFO was not yet as a common, parlance yet at
yes,
that
the
time.
general manager. General managers.
Correct. General managers in those days. So I think so because this as TSR sir was saying, this was a fallout of Bering's fiasco.
Yes.
Because in Bering's, Nick Leeson was able to instruct and manipulate the record keeping in the back office.
Yes.
To make sure that the losses are not seen.
Yes.
So that is the control, or what we call segregation of duties and responsibilities between the front office and the back office.
Yes.
So that was another good outcome
Yes.
out of that.
So the market reforms, the internal controls, the risk management, everything was undergoing a lot of changes, and it was getting strengthened during 90s, we can say that.
During 90s. So I think, if I can cover another point perhaps, see in 92, these problems happened in the BSE. Because
Yes.
there was only one major exchange.
Yes.
Of course, there were exchanges all over India.
Yes.
And in Bangalore, we had the Bangalore Stock Exchange.
Yes.
But at that time, what the powers that be, they decided we should create a new exchange completely technologically driven and away from the existing, you can say, clique or coterie of
Yes.
the BSE brokers.
Yes.
So that's how the NSE, the National Stock Exchange, came into being. And I think
1994.
1994 it got inaugurated. I think the late Mr. S.S. Nadkarni, the
Yes.
IDBI chairman, was the power behind that, and pulled in, of course, other senior people in the system. So that was really a landmark event. So if you look at all these kinds of reforms happening, right, I mean, that laid the foundation for Indian financial markets,
Yes.
Indian financial system to be world class, to be among the best in the world.
Yes. And incidentally, 1994,
Yes.
the new private sector banks came.
Absolutely.
Came in.
Absolutely.
No,
Yeah, that
we
is when
had-
the licenses were given to 10 new private sector banks.
Yes.
And, among those, if I can recall, out of the 10 licenses that were given, today there is only HDFC Bank, and
ICICI Bank.
IndusInd Bank, and ICICI Bank also. Axis Bank initially took birth as UTI Bank. And
Yes.
then it has become Axis Bank. So other than that, all the banks are gone. Other banks are
Merged.
gone.
It got merged.
It got
It
yeah,
got
those
merged.
names
Taken
are
over.
no
Taken
more
over.
there.
Taken over.
They got taken over or merged with other private sector banks. So yes, so those 90s saw the birth of new private sector banks also.
Yes.
Yeah.
So looking at all these things, we can say that the decade of 90s,
A decisive decade.
decisive decade,
Yes.
and which will never be forgotten, which will be the foundational years
Yes.
for the Indian
For the
markets.
subsequent development and growth
Developments.
and the evolution
Absolutely.
of Indian financial markets. And as we discussed, when we say Indian financial market, we talk about the government securities market, equities market,
Foreign exchange
FX, derivatives. The full spectrum, the foundation for these markets as we see it today were laid in the 90s.
True.
Yes. So anything else that comes to mind, sir, after the 90s?
Now, while these things were happening
Yes.
on market reforms,
Yes.
we also faced a lot of global events in the form of wars and the crisis.
Correct.
Particularly the attacks, the terrorist attack of
Terrorist
26
Yes.
9/11,
9/11.
Which happened in
9/11, which
2000
happened in 2001.
2001,
2001.
And,
Yes. 1999, we had the Kargil War, India specific.
India specific.
And then we had the Parliament attack in 2001. Other than the 9/11, the Twin Tower attack. And 2003, then we had the Iraq War,
Iraq War.
when US invaded Iraq. And things were quite
Volatile.
Volatile.
Quite volatile because
Yeah.
all this and the Asian financial crisis.
Asian,
So
yeah.
all this puts the market on a very volatile phase.
Yes.
So being in the treasury, how do you manage that sort of a volatility? Why that
Exactly.
volatility comes and how
Yes.
do you manage that volatility?
Yes.
Is a most important part of our functioning there.
Absolutely.
The volatility comes because once you have the markets opened up,
Yes.
then the dollars, the risk off, risk on comes,
Moves, yes.
happens, and then the risk goes off.
Yes.
Nobody wants to take risk.
Correct.
And then the dollars gets out of the country wherever it is there, particularly for countries like
emerging market
India,
countries
emerging
like us.
markets particularly.
Yes.
And when the dollars go,
Yes.
what happens is they buy dollars,
Yes.
and when they buy dollars, they have to give rupees.
Yes.
Whoever is we are talking about the portfolio investors and
Yes. The FPIs, as we call it today.
FPIs, those are. So when they buy dollars, they give rupees to the Reserve Bank, and then they take the dollars and remit it to their countries. So the US dollar.
Correct.
So in the process, what happens is the rupee liquidity
Yes.
within the system
Will get squeezed.
Gets squeezed.
Yes.
So that pushes up the interest rates,
Yes.
and when the interest rates move up, the entire bond markets get affected,
Yes.
and the money becomes costly. And because the money becomes costly, the corporates also have to borrow money at higher rates, and that affects their profitability.
Yes.
They pay higher rate of interest.
Yes.
So every segment of the financial markets gets affected
Yes.
once there is a global event.
Correct. Correct.
And that poses a lot of challenge to the treasury.
Correct.
Which manages the
Banks, corpus, the entire bank's money.
Yes.
Yeah. So what TSR sir is talking about, what happened, what we have seen in the 90s, it may sound very familiar because these phenomena do not change, because this is exactly what happened in the last 6 months, right? So there was a flight of capital, there was risk off, and RBI intervened aggressively in the rupee market, that tightened liquidity, that took interest rates higher, that reduced the confidence in the Indian equity market stumbled, and what we saw from 95, 96, the same thing we are seeing in 2024, 25. So since these things seem to keep repeating,
Yes.
sir, so should we, what is the lesson we should draw?
Yeah, before that, I just wanted to point out one aspect of the bond markets, which the Reserve Bank of India brought one operational guideline, which said that your portfolio has to be, this happened in 98, I think, 97, 98.
Right.
They said that your entire government securities portfolio should be classified into 3 buckets.
That was 99, 2000.
99, 2000?
Yes, sir. Yes, sir.
So
I remember because I was there at that.
Okay. Held to maturity, available for sale, and held for trading.
Yes. So before that, it was current and permanent.
Permanent, yes.
And I think the permanent part was around 10% of the book. 90% used to be current. And then when this 99, 2000, in all this, we had this turmoil in markets. And RBI issued the circulars at that time to reclassify from current and permanent. It became, as you said, HTM, AFS, and HFT.
While the held to maturity need not be marked to market.
Yes.
The other two, available for sale and held for trading, has to be marked to market. So that's how it came, and hence the valuation becomes important. The volatility
affects the P&L, the balance sheet of the banks.
Of the banks.
Yes. So HFT, I think there is a time limit of 90 days for holding that. I think recently some amendments have happened, but that is okay. The concept has not changed. HTM and AFS and HFT. So that brought more discipline and more order, sir, into the kind of trading that we are doing in the GSEC portfolio management.
Yes. So during all this volatility periods, we need to acknowledge that RBI was always there to save the banks in terms of its profitability. Because at times of volatility, when the market prices were falling, they know that the bank's profitability will be affected, and so they used to increase this HTM portfolio, which was typically 40% of the total portfolio. They used to enhance it and say that, okay,
you can, they didn't say it in so many words, but those which are out of money, you can, put it in HTM. Right. So, I think if I'm not wrong, it is not that they were doing anybody a favor. The issue is, as the central bank and the regulator and supervisor of the banking system, as a risk manager to the entire Indian financial system and to the Indian economy, you can't have a situation that banks are collapsing. Right? The entire economy depends on a well-functioning banking system. Right. So they were regulating and they were making amendments as changes and evolution as and when these kind of events were happening to keep the banking system resilient. So that they can serve the economy.
So it's very interesting to see how Reserve Bank of India looks at the foreign exchange market in one way and looks at the government securities market in a different way. The whole approach is different. In the case of foreign exchange market, the Reserve Bank of India is more concerned about the volatility of the rupee.
Right.
Because the import.
It is a determinant of your external sector and your global standing.
And our trade in everything happens on the foreign exchange market. So they are very clear that there is not too much of speculation happens in the foreign exchange market, and they used to intervene. They used to find out whether there are any speculative elements
Elements
are there.
there.
And they always encourage that the underlying should be there
Yes.
for the banks to buy and sell dollars.
Right.
So this is one aspect of it. When it comes to the government securities,
Yes.
the RBI understood that the governments are the major buyers of the bonds issued by the government.
Or the
of
banks.
India, or the banks in
Yes.
the form of SLR.
SLR.
And so they should not be unduly affected. Their bottom line should not be affected because of the global events and volatility.
Yes.
And they were able to intervene in the markets
Yes.
and help the banks to tide over the temporary
difficulties, temporary volatility.
So this is feature of the Indian market.
Indian market. Absolutely.
And,
Absolutely. And I think from those years, I think one big change in recent times, what we see is earlier banks were the biggest buyers of government securities.
Yes.
Now you have so many other
FPI is also been
FPI is there, and EPFO, pension funds, and provident funds are there, and insurance companies are
Yes.
there. These have become collectively a larger buyer or a source of demand for government securities as compared to just the banks. So that's a very important structural change and evolution in the government securities market.
One problem which still persists even till today is that the retail segment, like individuals like you and me, we don't have scope to buy government securities and keep it in our demat accounts.
Demat accounts, I think RBI tried that, I think in 2022 or something like that. It just didn't take off. And RBI Direct is something, a web facility where you can buy GSEC has been started. I'm not sure how successful it has been. Because typically as a retail investor, you look at, if you don't want equity, just leave the equity aside for the moment. You'll probably look at gold, you'll look at real estate. If you look at other financial instrument, you will start with a bank FD. And in a bank FD, if you are getting 7.5%, why will you buy a 10-year government security at 6.7? Because there is no benefit in terms of taxation, because government securities are fully taxable, the income from government securities. So I think retail, maybe it may not pick up steam for some time.
So when we are talking about this market reforms of 90s, one thing globally which was getting developed was the Basel Accord.
Yes.
The Basel is a place in Switzerland, where the G10 countries used to come and meet, and then they were looking at how the banks can be strengthened to handle any of this. So this happened during the period of 1988. The Basel Accord 1.
As far back as 1988.
And the Basel II came in 1999, implemented in 2004.
Okay.
Where the market discipline, the supervisory role, and the internal controls.
Yes. So those were brought in.
Those were brought in place to ensure that the banks are on a strong footing.
Right.
So this happened again in 90s. The thick of the action was in 90s. So 90s provide us that sort of
a crucible through which so many events took place,
market
and
reforms, developments,
and that was the kind of the root of so many other developments and refinements.
And the volumes were also catching up in all the markets, whether it is equity or foreign exchange or government securities market. And the GDP has moved to $3.5 trillion.
So I think in 92-93 our GDP was something around 330 billion. And now we are almost at $4 billion.
Closer to $4 billion.
$4 trillion. $4 trillion. So I think hopefully it will keep continuing to grow. And if you talk about this, government securities, when I first joined the Treasury in 97, per day volume used to be 1,500 crores, something like that.
True.
Right. So now it is daily volume has gone to 35,000-40,000 crores. On a good day, you'll say 50,000-60,000 crores also. So the market has grown in volume and liquidity. And, price discovery is much better, very transparent. But, sir, I think, as you mentioned that not all securities will be traded on a daily basis.
True.
So, that has not changed. Even now, the most liquid 3, 4, 5 securities will be the bulk of the percentage of the volume of the market. But I think that's not something that is going to
one of the, as you will agree, one of the key indicators of a developed market is the yield curve. How stable is the yield curve? How liquid is the yield curve? And stuff like that. At what rates, at different tenors can people borrow of different businesses?
As you rightly mentioned, so this has been the endeavor of RBI to try to develop a sound yield curve for the Indian economy. And I mean, I should say that they are still trying.
Still trying, and still we are evolving in that respect.
Yeah.
And so as the market, as Indian market develops,
Yes.
I'm sure that all this liquidity will fall in place and we will have.
Yeah. So I think one major change over, let's say, 90s to now, or in the last 20, 25 years, the length of the yield curve is materially increased.
Yes. It has gone to 30 years now?
No, it's 50 years.
50 years?
50 years. So I remember the 10 quarter 2021 was the first 20-year bond. Right. So 10 quarter 2021, we thought, my God, it's 20 years plus at that time. Now we have 50-year bonds. And that is because, again, the structure of the market has changed, where you have pension funds and provident funds and so on who need such long-dated assets to meet their long-dated liabilities.
True.
So that is one good feature. So, sir, we have covered the period from 91 to, let us say, 2003, 2004. Right. So, these are the things which are transformational for the Indian financial system. As a treasury manager, anything that you would like to share as, how you manage this kind of changes?
So, the volatility had always been a challenge for any of the guys working in the treasury.
Yes.
And so, depending upon the type of volatility, depending upon the time frame, we take some measures.
Right.
And so, as in some cases, I remember we sold the treasury bills and generated liquidity, and then we went long. And made sizable profit.
This was 9/11.
9/11.
And this is an event that we should remember. Another of our very dear colleagues, Mr. Mankat.
Yes.
JP Mankat. Right. That was his kind of brainwave. So he said, why don't you sell these T-bills and buy the long-dated GSEC? So that was.
We were wondering how we will raise liquidity.
Yes. So that was one. The other is the Southeast Asian crisis, 98.
Yes.
So when money was so tight, but then whatever funds we could gather, we bought a whole bunch of CDs and CPs. Around 1 year, and then the kind of yields we logged in, I cannot forget, 28%, 30% on CPs, 1 year CPs. And that held us in good stead, because see, what happens, this kind of turmoil, right, these incidents or events, they too will pass.
True. And they give opportunities.
Yes. So it is not that you should get shocked or you should get worried or you should get depressed by these incidents. You should understand the dimension of these events and be ready to grab the opportunities that such events throw up.
True.
Right. So that, I think we have done that many times with TSR sir as the boss. Right. And another instance that comes to mind is the year 2000. So for Y2K, when it happened at that time, our chairman, the late Mr. K R Ramamurthy, a very eminent banker and a very dynamic chairman, and he took great interest in our bank treasury, and he was kind of mentoring us. And I think you would remember very great conversations.
Yes, during monetary policy times.
Monetary policy time with KRR, and he was a brilliant guy. He was on the ball when it comes to any budget day, any monetary policy, any of those. And why I mentioned KRR is for Y2K. He was on the RBI's committee panel to manage Y2K crisis, and that time all people, even from Treasury, right, they were sent to all branches to be there as standby staff in case there was some issue, because of Y2K. Thankfully, nothing happened. But in that scenario, in that context, what the RBI did was they changed the definition of what cash is. Right, and temporarily to enable smooth conduct of cash withdrawals from the banking system for the general public, they said the cash can be considered as CRR for some time during that Y2K period. Right, I remember that circular which came out, and TSR sir read that, and we started discussing, and he very correctly identified that this will lead to an enormous jump in liquidity, because whatever is there as cash, if it becomes CRR, suddenly you have excess CRR. And CRR doesn't pay you anything. So what will banks do with CRR? They will start deploying it in different market instruments. So then we started buying GSEC in a big way, and we made a lot of money in that. So basically, as a trader or a fund manager or a portfolio manager or a treasury manager, I think the first step is to be a good analyst. Right.
Understand, connect the dots.
Right. You should analyze, understand what's happening around you. Then, stay firm to purpose. Don't get, disturbed by these events.
True.
Look for opportunities, move decisively. And then you can enjoy the fruits of that at a later time and date.
True.
So that is.
So to work in a bank's treasury
Yes.
is really one has to be lucky to be there
Yes.
and deserving
Yes.
and to be there. And it had always been a wonderful experience.
Absolutely. And it was a great experience for me, and I was very lucky to get that opportunity.
Yes.
And as we go along, I think it has become probably more and more difficult because now the leading private and foreign banks just look at IIT IIMs. In our times, at least, chartered accountants were favored in Visa Bank Treasury, and some MBAs like me. So that things have evolved, and but the markets continue to be a very exciting place, and the bank treasury can be a very, very enlightening and enriching experience. So,
Hope the audience would have found it useful.
I hope so. And throughout this journey, of course, TSR sir was there, and if I can say, he was my mentor and maybe sometimes my tormentor also. But even those things you have to take in stride. So because your leaders and managers will be good advisors, and you just have to kind of grow. And in that environment.
And the case is same with the students also. They also call me a tormentor.
Is it so?
True. Outwardly, I'm a tormentor, but I think
you have the best interest at heart.
Absolutely.
Yeah, that is how it is. So I hope the audience finds this useful, and please give your feedback. Anything more you want to learn or understand, if you have a query about any of the things that we have talked about, please feel free to contact us. So TSR sir, thank you very much for coming for this discussion.
Thank you.